This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 3 videos on scaling into a trade. I'll begin by talking about who scales in and why they scale in. Next, I'll move on and talk about scaling into a winning trade. I'm going to use this slide to illustrate scaling in to a winning or a losing trade. We have a bull trend and then a bear channel, which is also a bear trend. Scaling in is a technique that traders should consider using after they have some experience trading, and preferably after they've become consistently profitable. It's difficult for beginners. It's tempting because they understand that it can increase the probability of success, but whenever you increase your probability of success, you additionally increase your risk. Also, there are added decisions that you have to make, and sometimes you have to make them quickly. And one of the common mistakes that beginners make is they don't know when to get out, or they refuse to get out. Their losses start to grow. They no longer are objective. They manage their trades incorrectly, and then they end up losing much more money than they ever expected. However, strong trends do offer great opportunities for traders to scale in, add on to their position as the trade continues. For example, at the beginning here, we have 5 consecutive bull bars, and then we have a little pullback, and then we have a breakout. So it's a strong bull breakout. It's reasonable to buy here, and your stop goes below the bottom of the bull trend down here. And if you're still long at this point, we have another breakout, another bull flag, 3-bar pullback, but then we have a bull bar. So it looks like the trend is resuming. You can buy on a stop just above the high of that signal bar. So now you have a bigger position. Every time there's a strong breakout, especially to a new high, traders raise their stop to just below the low of that new leg up. One of the most important things when scaling into a trade is trading the appropriate size, and it's often much smaller than you think. And I call it the I don't care size. You have to trade so small that you really do not care. You need to remain objective, and you can only remain objective as long as you're not thinking about money, and instead you're thinking about the trade. Am I doing what is right based upon the charts, not based upon a growing loss in my account, or not based upon my risk increasing because of my increased position size. Traders starting out often cannot remain objective, and therefore scaling in is emotionally too difficult for them, and they need to wait. Every trade eventually ends. Every trend eventually ends. Here we have a micro channel lasting about 8 or 9 bars. That's a breakout on a higher time frame. Here's another breakout, even stronger. And then look at this. We have an even stronger breakout. So we have consecutive buy climaxes there, a bigger one here, and an even bigger one here. This one is the biggest one occurring after 20 bars in a trend. Whenever that happens, it's more likely that it is the final leg of the trend, or near the final leg of the trend, and the trend is about to reverse. A breakout that strong often has one more push up before it tries to reverse. Selling a first reversal down, especially below a bull bar or at the bottom of a tight trading range, is usually not a high probability trade. However, after the market has 1, 2, 3, 4 bear bars, 3 of them closing on their lows and having a decent sized body, then we have a big up, big down, big confusion setup. probably the best the bulls will get over the next 10 or 20 bars is a trading range rather than a resumption of the bull trend. Because of that, bears are starting to sell. For example, they'll maybe sell this close. And because it might be a trading range, they have to put their stop above the high. It may also be a bear trend. On a higher time frame chart, this 5-bar bear channel is probably a breakout, so we might get a spike, pullback, and channel, which we did. Traders will sell. Some traders will sell the close of that 4th consecutive bear bar. Some will sell the close of that 3rd or even the 2nd when the 2 bars are as big as they are in closing near their lows. This bar closed below the low of the past 6 or 7 bars. And we have a wedge. You can call it a wedge. 1, 2, 3. Also, very strong bull breakout, strong enough for a second leg up. That's the second leg up. And it is not strong, so traders are expecting a reversal. Strong enough leg down, bears will put their stop above the top of the bear leg. Whenever there's a strong trend that has consecutive buy climaxes or a wedge, 1, 2, 3, traders are expecting 2 legs down, 1 and then pullback and then 2. Some traders will wait for a bear bar like this, a weak rally, 2 legs up, 1 pullback, 2, and they'll sell below the bear bar, or maybe they'll sell here, a wedge, 1, 2, 3. So a small wedge, lower, high, major trend reversal. Bull trend, strong bear breakout, weak rally, testing the prior high. So traders are looking for a second leg down, and they'll sell below there. So they sold here, they're losing money, and they add to their losing position. But when they're selling here, they knew their stop was up here, and they knew they may want to sell more higher. So they traded small enough so that this position plus this position would not create too much risk using a stop up here. When they sell higher, their average entry price now is in between the two, so their average entry price is right here. Whenever you add to a losing position, you're only doing it if your premise is still valid. It increases your probability, but whenever you get high probability, you have to pay for it. And the other side of probability is risk reward. If you're going to create high probability, you're going to pay for it with worse risk reward, and usually with greater risk. So you're doubling your position size, so you're increasing your risk. Some traders, when they're increasing their position size and it's a losing position, they've given up their hope of making a profit. Instead, they've changed their goal. Instead of hoping for a profit, they're simply trying to reduce or eliminate their risk. So, for example, let's say an optimistic bull did not think about this as being a likely exhaustion bar, and instead he saw a pullback 1, so a high 1, and then a high 2, a small double bottom, and he bought above that bar. And then he starts to see this, and he's saying, oh my gosh, it's not good, it's pulling back. But after a strong bull trend, the first reversal down usually results in a trading range and not a bear trend. Maybe it's safe to buy more lower. That's his stop at the bottom of the most recent bull breakout. Now he has a strong bear reversal. And he knows when a reversal is that strong, the market probably will have a second leg down. He also sees the consecutive buy climaxes and the wedge, 3 pushes up, 1, 2, 3. So he expects 2 legs down after such a strong bear reversal. However, he also knows that it was reasonable taking this buy. Usually, if you do something that's reasonable, and then you manage your trade properly, usually by scaling in, using appropriate stops, you can either make a profit or avoid a loss. So what a bull might do is buy here, sit through the bear trend. It's around a 50% pullback. And he waits for a bull bar. And then he buys above that bull bar. Or he might say, 5 bear bars, maybe I better wait for a second entry buy. So maybe he'll buy above this bar or that bar. However, his goal at this point is not to make a profit. He believes that the market's going to have a lower high and a second leg down. But he also believes doing this was rational, and buying above a bull bar is rational, so the market will probably let him out break even. He's buying here, hoping to exit exactly at the midpoint of his 2 entries, here and here. That's his first entry, just a little bit above that bar. His second entry is a little bit above this bar, and the average entry price is right here. He might place a limit order to get out at that average entry price. If it's not filled, and then we get a micro double top, up, pull back, up, he'll then get out below the low of that bar. By taking the second entry, he either eliminates his risk if he got filled there, or he reduces his loss. So he eliminates his loss, gets out break even on his trade here if he gets filled. If he does not, he'll get out here, and he'll still have a loss, but it will be a much smaller loss because he scaled in here. The bears are thinking the same thing. Wedge top, strong bear reversal, 2 legs down, so they're looking to sell a lower high. So they'll sell exactly where the bulls are getting out. We have a micro double top, 4 or 5 bars up, a reasonable sell, and it's a 50% pullback. I talked about 50% pullbacks in my other videos. At 50%, the risk for the bears is here, and minimum reward is here, about the same. And for the bulls, their risk is here, their reward is here. But in this particular situation, the odds are we're going to have a second leg down. Yes, the risk and reward is equal for the bulls and for the bears, but the bears have higher probability, so it's a reasonable short. The bears will sell a 50% pullback, either with a limit order or on the reversal down. Whenever traders scale in, they have to have a plan. How many times are they going to add to their position? And what intervals? How far apart will their entries be? What size? And then they also have to know when they plan to exit, and if they're planning to exit with a profit or a loss or a break even. I talked about adding to a winning position in a strong trend, buying here, stop here, and then buying more higher. New stop. And I talked about adding to a position where you're probably going to lose money and you're trying to avoid a loss. I also talked about adding to a losing position. Bears selling here, expecting that it's such a strong reversal after a wedge, the market's going lower, probably at least to the bottom of the buy climax, and it probably will have 2 legs down. It may just go straight down. It may bounce first, but in either case, the bears know the probability is they're going to make a profit. They sell here, thinking that, okay, I'll put a stop up here, but I'll trade small enough so that if in fact we enter a trading range, I can sell more higher and then either avoid a loss or make a profit. The bear sells here. He has a losing position at this point. He sells more here, stop up here, and he trades small enough so that if that stop gets hit, his entire position will not result in a loss any bigger than he would get on any other trade. And if he held for a swing, he ended up making a nice profit. Now, who scales in? Professional traders do it all the time. For example, a fund manager, like billionaire Cal Icahn, Warren Buffett for that matter, might be scaling into positions. As he's trying to take over a company, he may increase his stake even as the company loses money and loses value. Here's an example with Carl Icahn. In December of 2015, CNBC reported that Icahn added to his losing position in LNG for the 8th time, even though it had fallen more than 50%. It kept falling and falling and falling, but he believed it was undervalued and that it would reverse up. He added to his losing position 8 times, but each addition did not increase his position size to an uncomfortable level. He was able to remain objective. Individual investors also scale in. If you ever watch Cramer on Fast Money, he'll sometimes tell you, buy part of your position now, and then wait a few days and buy part more. And then you also hear about averaging down, or dollar cost averaging, which is a very common, sensible approach to investing for individual investors, like buy a tenth of your position this month, and then no matter what the stock or market is doing, buy a tenth more next month, and you do it for 10 months. And that is scaling in. You might be scaling into a winning position, you might be scaling into a losing position, but dollar cost averaging is a common, sensible way for long-term individual investors to enter the market. And then another group of traders who scale in regularly are short-term traders, traders holding positions for a few days, a few weeks, and day traders. Here we have a pretty strong rally, a very tight bull channel. Probably the first reversal down will be limited. Stop down here. If this is a bull trend, it should not fall below the bottom of the most recent strong bull breakout. Some traders might buy here with the intention of putting a stop below here, and if it pulls back, they'll buy more. One way to do it is you could buy with a limit order below that bear bar, betting will not fall below here, or they'll simply buy more 10% lower, or a certain number of ticks or pips lower. Or they'll also buy on the reversal up. We have an II bull flag after a strong reversal up from a higher low. I mentioned dollar cost averaging. Investment advisors often tell their individual clients, do not buy the entire position at one time. Instead, divide your entire account up into pieces, like for example 10 pieces or 12 pieces, and then you buy each piece every month or so until you have your full position. For example, if this were a stock, let's say it's XYZ stock, and you wanted to buy 10,000 units of the stock or 10,000 units of a Forex position, and you're planning to hold for a number of years, 5 years, instead of buying all 10,000 units or shares or contracts all at once, you might go ahead and buy right when you make your decision. So let's say sometime in here you're deciding, yeah, I really want to own this and I want to hold it for a long time, but I don't want to buy the full 10,000 units right now, because suppose it just keeps falling all the way down here. Then let's say it falls 20%, then it has to go back up 20% for me just to get break even. So maybe I'll just buy part of my position. If it goes up higher, I'll buy part more higher. I'll buy part more higher. And instead, if it goes down, I can add to my position, relying on my stop here or here. As long as my premise is still valid that I think it's going to go up, I'll be comfortable adding to my position. So let's say he started buying right here, and then he bought another 1,000 here, 1,000 here, 1,000 here, 1,000 here, all the way, every month he bought 1,000. And here at 10 months, this would be his average entry price. Even though he started buying here, his average price now is here. And that's including after a sell-off. Now he's got a sell-off and a reversal, and he has a reasonable entry price now that we have that reversal. And the advantage to the trader is he avoids the uncertainty, possibly buying too high. So he increases his probability of profit because he's getting an average entry price, a price between the high and the low over the next year, instead of possibly buying the high over the next year and hoping for it to go higher. This is a common situation. Here we have a bull microchannel, 6, 7, 8 bars, and a beginner will look at that and say, yeah, it's going up. And he believes it'll continue to go up as long as it stays above the bottom of the most recent strong last leg up. So let's say he buys for any reason. The sixth close, buys below that low, buys above this high, buys a bear bar betting that the first reversal down will fail. His stop goes down here. If he's looking to buy up here and the stop is too far away, he can wait to buy where a scale-in trader might add to a position and still use that correct stop. For example, he might say, well, I don't want to buy up here. The risk is too great. I'll buy a pullback, maybe a 50% pullback. So then my risk would be half of what it would be had I bought up here. That's okay. The only problem is sometimes you don't get the pullback. So let's say right here you're planning on buying, looking for a 50% pullback. You don't get any pullback until all the way up here, which is a much worse price had you bought right here. He waits for his 50% pullback, and now he sees a pretty good reversal from a higher low, strong reversal bar, down, up, good reversal, II with a bull bar, and he can add to his position here after a micro double bottom, down, up, micro double bottom with a strong reversal up. Day traders, short-term traders, they'll scale into losing trades to increase their probability of profit and reduce their chance of a loss. Again, whenever you try to increase your probability, you have to pay for it. Anytime you're going to get something good, you have to pay for it. Nothing is free. And usually when you increase your probability, you're going to increase your risk. You're certainly going to reduce your risk-reward ratio. Usually greater risk and sometimes less reward. So let's say a trader buys expecting a continued rally, even if there is a deep pullback, as long as the pullback remains above the bottom of the most recent bull breakout. So that's his premise, that it's a bull trend as long as there's not a credible top. This is not a credible top. And as long as any pullback, no matter how strong, remains above the bottom of the bull leg. He might buy here. He might buy the second consecutive strong bear close, saying we got a bear breakout below these bars. We have a follow-through bar. Some bears will think this is always in short, but as long as it remains above this low, I'm going to bet that this breakout will fail and that it's a bear trap, trapping bears into selling this close, selling what might turn out to be the bottom of a pullback in a bull trend. He might buy that close knowing that weak bears will sell the close hoping to break below here, but he still believes this trend is so strong, any reversal attempt, even a strong one, consecutive bear bars closing on its low, will fail, so he'll buy more lower. If he's sufficiently disappointed by the strength of this bear reversal, he might decide, okay, maybe we're going to go sideways instead of up. Here's my first entry price, here's my second entry price, here's my average entry price. I'll place a limit order to get out break even. So if he buys here and immediately places a limit order at the midpoint of his two entries, he might get out here. In that case, he would be averaging into his trade to avoid a loss and not so much to make a profit. However, he could hold and he would end up with a very nice profit. Another alternative is you could buy that, buy more here, and then try to make a profit on his second entry and get out break even on his first. So he buys here and immediately places a limit order to exit the entire position at his first entry. So he gets out break even on this trade and then with a profit on this trade. That's another common approach that traders use. Now I'm going to talk about scaling into a winning trade. Strong bull trend. A bull might buy a pullback, an attempt at a reversal, but then the reversal looks like it's going to fail. The bull might buy the resumption up from the pullback, so the breakout above the pullback bar. Stop, obviously, at the bottom of the bull breakout. And he might add to his longs as the market continues to rally. He could buy for any reason, but he wants the space between each of his entries to be at least as big as a minimum scalp. So he doesn't want to buy and then buy later at the same price. If he's going to be buying as the market's going up, he wants the second entry to be at least the size of a scalp more than the first entry. And he has to keep calculating his total risk based upon the position size and his stop. And he has to make sure that his risk remains within his comfort zone. Another bull flag, another bull breakout above the bull flag, buy more. We have a bull breakout to a new high, put the stop below that new bull breakout, which is above his first entry price. So now he's entered twice. His position is twice as big as it was initially, and his stop now is around his first entry. Another bull flag, a high 2 bull flag, 2 small legs down, 1 pullback 2, and then we have a bull bar. Maybe he'll buy more on the resumption up. Here, this looks like we're getting small bars, doji bars. We might be forming a tight trading range, so his premise might change. At this point, he might be thinking, well, maybe I'm buying a bull channel instead of a bull breakout. Maybe I'll start using a tighter stop, especially if the position is getting big. If his premise is still valid, that it's now a bull channel instead of a bull breakout, it still should form higher lows. So this low should stay above that low. So he could use a tight stop, especially if he's then adding on and now has a large position. Very strong bull breakout. Traders have to be very quick to reduce their position size to a normal position size if the breakout is no longer a strong bull breakout, if it starts to convert into something else like a bull channel or a trading range. An experienced trader will be very good at detecting a loss of momentum and a possible transition into a channel or a trading range. If at any point their premise is no longer valid, they'll exit their entire position. So if they buy here and buy more here and buy more here, they're buying it on the premise that perhaps it's a breakout that may continue up much higher before it transitions into a channel. However, if the market does something to make them question that premise that the breakout will continue a long time, they'll be quick to get out. Here we got 1 push up, 2 pushes up, possibly 3 pushes up to a parabolic wedge top, and we might reverse at that point. We got a doji here, a small bar here, a doji here. That's looking different from this, where we had consecutive bull bars, consecutive bull bars, consecutive bull bars. The market's starting to look different. We have a possible buy climax and a tail and a doji, a small bull bar, and then a doji bar, and then a possible parabolic wedge. 1, 2, maybe we'll just go up a little bit and form 3, and then start to reverse down. When traders see that, they're thinking that maybe the market is transitioning from a strong bull breakout phase into either a trading range or a channel. Again, look at the character of the bars. A bear bar now. We have not had a bear bar since here. Small bar. This bar is below that bar. Here we have been pulling back for 5 or 6 bars. A breakout with shrinking bodies, and then a doji, small bar. So these bars over the past 10 bars are different from these bars. So the premise of a strong breakout has changed. This is no longer a strong bull breakout. It's a bull channel, but it might also be a trading range. We could easily trade back down here. When you start to see smaller bars, overlapping bars, the channel, the slope of this is not as steeply up as is this. Beginning tight trading range price action here, here, here. In fact, the entire thing might be part of a big tight trading range. So at that point, now we have a wedge, possibly wedge, higher high, major trend reversal, bull trend, small breakout wedge. It's still a small pullback bull trend at this point, but it's no longer a breakout. A trader might want to reduce his position back down to a normal position size at this point. Had he bought here and then added here, so a double position, and then added here, so a triple position, at this point he may cut back down to a normal size position. Or he may exit entirely. If he exited entirely, look at what happened over the next 30 or 40 bars. No profit. Exiting entirely would make sense. Here we have a very strong bear trend. It's a sell the close bear trend. Well, at this point or that point, it's a sell the close bear trend. Traders are selling. They'll sell that close, this close, this close. They'll sell the bull close. They'll sell that close, this close, this close. Here are examples of possible entries. They can add on. They can just they take a position here, sell more here, sell more here. You're not going to sell more here if you sell here because this is not at least a scalp size below this. A lot of traders will take one of these trades, maybe one or two. A lot of traders will take one, scalp out, and then take the next one. But let's say you're adding to your position and you take 2 or 3 of those. Then fine. You got to be trading small enough so that a stop up here will not create so much risk that you will not manage your trade properly, and so much risk that you have a greater risk than you have on any other trade. And most traders cannot think fast enough to sell more, sell more, sell more. And they should only take one of these entries, doesn't matter which one, any one, and use the appropriate stop, and then just hold for a swing until there's a pretty strong reversal up, and then get out down here. Some traders will sell here or here and then see these additional entries. Instead of adding them to their swing position, they might scalp. So you sell here, here's another sell, I'll sell this one for a scalp. Here's another sell, I'll sell this one for a scalp. Another sell, I'll sell for a scalp. So they hold their initial swing entry and then they scalp additional entries. And then other traders, as I said, some experts, will just keep adding to their position until they believe their premise is no longer valid. Low 1, low 2, so a low 1 or a low 2 bear flag. Here we have a pause bar. We went above it, so this is a pullback, and that makes this a low 1 sell signal bar. So some traders will sell below the low of that bar on the reversal down. There are many ways to sell in a bear trend. As I said earlier, if you're scaling into a winning trade, you want the next entry to be at least a scalp below the first one. So if a scalp in the E-mini is 1 point, you don't want to be selling again unless you're 1 point lower. Consecutive sell climaxes, climax, big trend bar, so a climax, big trend bar, so a climax. So if you were scaling in and you see consecutive sell climaxes, you know there's a risk of a pullback or maybe even a trading range. It's a good time to reduce your position or possibly even get out entirely and then wait for another sell signal before selling again. We had a strong breakout and then we got consecutive sell climaxes, so the premise of a strong breakout is no longer valid. Look at this. The strongest pair of bear bars occurring 20 bars into a trend. You have to be thinking about the possibility of an exhaustion gap, a final sell climax, and the end of the trend. So whenever you see the strongest pair of bear bars occurring late in a trend, you have to be thinking that 75% chance the gap between this close and this low will probably close. It's probably an exhaustion gap, not a measuring gap for a measured move down. So that is a good reason for bears to exit. Smart bears will buy back their shorts here. It's no longer sell the close. We have consecutive sell climaxes. 1, 2, 3, 4, 5, and then 6, and we have a huge sell climax very late, 20 or more bars into the trend. The bears know it's probably not going to go much further, and in fact, we'll probably get a couple legs sideways to up. So a smart bear would buy back his shorts here. And a smart bull, an aggressive bull, would buy here. Other bulls will wait to buy the reversal up, but they could buy here and then put a stop down here, maybe based upon a measured move down from here, thinking that strong enough maybe we get a small second leg down. But if we do get a second leg down, we'll probably then reverse. Either reverse here, or maybe we get one more small leg down and then we reverse. If you're adding to a losing position, you only want to add to your position if you believe that your original position is still valid. So let's say you look at this and say, it's a buy the close bull trend. It's not all that strong. We have tails, we have bear bars, tails. This looks like a bull trend and what will end up as a trading range, but it may go up much higher before it begins the trading range. It's okay to buy here if you're willing to put a stop all the way down below the bottom of the bull leg. Putting it down below the bottom of the buy climax is not good, because if this is a bull leg and what will become a trading range, it usually will fall below the bottom of the final buy climax. Trader buying up here, he knows he's buying in a weak rally that's probably a bull leg and what will become a trading range. He sees the wedge top. He could buy hoping that we go up a little bit further and he can make a profit, or he can buy knowing that we may pull back deeply, because if it's a trading range, we could get a very deep pullback. However, if it's a broad bull channel, the deep pullback should stay above the bottom of the most recent leg up. A trader buying up here only buys up here if he's going to put a stop down here. Strong bear reversal. It's possible that his premise is no longer valid, that we're not in a broad bull channel or any kind of a bull trend. Instead, we could be in a trading range or in a bear swing. Most traders, they got a bear breakout, a pullback, and now we have a low 2 short, low 1, low 2. Most traders should get out either on that close, above this bar, below that bar, below this bar, and then just wait. But some traders will hold and put their stop down here and then look to buy a reversal up lower. Just like the rally had problems, it was weak. Look at the sell-off. A big bear bar, but a disappointing follow-through bar, and then a doji bar, doji, doji, small bar, doji, doji. Just like this looked like a bull leg in what would become a trading range, this looks like a bear leg in a trading range and not the start of a strong bear trend. A bull who bought here might hold long, stop down here. Some traders don't like to be getting in, getting out, getting in, getting out. They just buy and hold as long as their premise is still valid, and they use an appropriate stop, which is often very wide. A scale-in bull who bought here with the intention of scaling in lower, as long as his premise was valid, he buys here with a stop down here, but he's buying small enough so that he can buy again on a reversal up above a bull bar, or above here, a double bottom higher low. So he buys here and then buys more here or here, stop here, but he makes sure that he's trading small enough so that his combined position does not create more risk than any other trade. So he bought here, and he bought more here or here, stop down here. As I said earlier, these scale-in bulls often exit the entire position back at their original entry. So they get out break even on their first entry and then with a profit on their second entry, whichever two it was. However, a bull who buys here and he places his limit order to get out of his entire position here, break even on the first, profit on the second, and then he sees this, it starts to become a buy the close bull trend. He might decide to only exit half of his position here because this is such a strong bull breakout, we're probably going higher. Biggest bull bar in a rally that's lasted more than 20 bars, probably an exhaustion gap. So the gap between this close and this high probably will close. So we'll probably reverse down below that high. And then we have a bear bar here and a parabolic wedge. We're having a bull breakout above a bull channel, probably going to fail and go at least sideways to down. So at this point, the premise is no longer valid that the bull trend is still in effect. Most traders, if they bought for any reason, should be getting out of longs here because bears will be selling there looking for at least 2 legs down.
In this video, I talked about traders who do scale in, and that includes everyday individuals trading their own account at home when they do dollar cost averaging. Next, I moved on and talked about scaling into winning trades. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the end of video 35A, Scaling In. This is the first of 3 videos on scaling into a trade.